Federal Reserve note has lost 99.434%. That's why I said the dollar is collapsing, the fiat or paper dollar is collapsing. Unfortunately for the world, because this is going to affect all currencies.
Now, if it sounds like I'm pro-bank, no, I'm just pro us getting the silver we need. The silver price is going to go up anyway, okay? And yes, I would love for the bullion banks to get hosed because they don't have the silver because of the tariffs. But all it would do is if we raise the tariffs, it would just drive the silver somewhere else and we won't get it and the price will still go up. But to reiterate, it would be suicide if we tariffed all incoming silver. We would not be making manufacturing great again if we did that. All it would do is drive up the price and push all the silver in the world into China's hands.
Since Donald Trump returned to the White House on the 20th of January, the US dollar has weakened 10.7% on its DXY index, while gold has risen 33.4%. Over the past 6 months, all G10 currencies have grown stronger against the dollar, with the Swiss franc posting double-digit gains. Global financial analysts MarioInnecco and VinceLanci share powerful insights regarding the uncertainty in the market. To demonstrate the dollar's total collapse, MarioInnecco found that just $100 worth of old gold coins is now valued at nearly $17,700 in today's money. This is a stark illustration of how the paper dollar has lost more than 99% of its value compared to gold. Innecco warns this is the same endgame that played out during the 1934 gold confiscation, the 1971 gold decoupling, and this time, it's global. According to expert forecasts, the price of gold in 2028 is likely to rise due to changes in the global economy, inflation, and increased demand for safe assets. Gold is expected to remain in high demand as a hedge against inflation, which is likely to drive its price further. We are told inflation is under control, but Innecco warns it's already hitting us hardest while policymakers ignore it. Trump's call for 100% tariffs will only push countries towards de-dollarization. Some of the recent weakness in the dollar might reflect the fact that gold's share of international reserves has been increasing since the U.S. froze Russia's reserves when the country invaded Ukraine in 2022. The central banks of countries hostile to U.S. interests have been buying more gold and holding on to fewer dollars as a result. That has been bullish for the price of gold. Whether intentionally or not, U.S. policy is undermining global trust in the dollar. His final warning is blunt. Have you got gold? Because you're going to need it. Before we dive into MarioInnecco and VinceLanci's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
The reason I'm showing you these is not to brag or anything, is just to say that we've got $100 here, right? $100. So what I did, I weighed these coins in grams, then I multiplied the weight by 0.9 because it's 90% gold. And then so I got 151.02 grams. So you can do this experiment yourself as we go further to see how much the dollar has collapsed. So after that, I divided that number, the 151 number, by 31.1035. That's how many grams there are in a troy ounce. Yes, a normal ounce only has 28 grams. So for gold, you need to remember troy ounces. So that number, 31.1035, is a really important number. So I got 4.855 for troy ounces of gold in $100. That's what $100 is. So after that, I took the price of 3,645. I did that yesterday. Right now, as I speak here at 7:30 a.m. London, we're at 36.43, but this will do. So yes, in fiat or paper dollars, this is worth 17,697.94, which is like, seems crazy, doesn't it? Just a few coins worth those many paper dollars. And then I calculated how much, the $100 currency has devalued versus real gold. And the reason I did $100 is because there's an old picture that I wanted to show you here. It's a really famous picture. It says, on this day in 1929, and I think this was October 30th, it was from the Chicago Sun-Times, Walter Thornton, a bankrupt investor, is seen here trying to sell his car for $100 cash after the stock market crash. Yeah, some people might think, well, it wasn't that much money, but it was that much, right? So I did the calculation, and you can do it too. The paper dollar, or the fiat dollar, or the Federal Reserve note has lost 99.434%. Yes, that's why I said the dollar is collapsing, the fiat or paper dollar is collapsing. Unfortunately for the world, because this is going to affect all currencies, this is getting parabolic. The collapse or the rise in gold and silver is going to get parabolic, and the drop is going to get really steep, as you can see by this chart here. And I've touched upon this chart, and I did an update on it yesterday. And you can see, you just do the price of gold, and you do 1 divided by the price of gold on tradingview.com, and it gives you the opposite of the normal chart, which goes up, right? So this gives you a good idea, and it says 0 really here. We're the thing is that from 99.43 to 0, or to 100% loss, that will be that's the period we're in right now. I can't tell you exactly how many years it will take, but not more than 10 years. I think we're in the end game, and what it will mean when it's 100% gone is that you won't be able to exchange your fiat dollars for these. And that's why it's so important to be able to stack some of these, and also silver for that matter. And we can look at silver later on in another day, but I wanted to touch upon gold today. So you can see here that there was a devaluation of the dollar back in 1934 by President FDR. I think it was January 30th. He devalued the dollar from, or revalued gold from $20.67 per troy ounce to $35. You can see that since 1833, it was at that same level. For 100 years, the dollar was real, was fixed weight of gold. They kept it at 35 from 1934 to 1971. And then they did the unthinkable. President Nixon, he detached money from reality, or the currency from reality, into mythical values. And that's why when you look at charts of any economic or financial indicator, from a long-term chart, you see that in 1971 things changed. It was because of that. And so the dollar is basically detached from reality. And unfortunately, people that hold dollars or treasury bills, notes and bonds, and euros, pounds, yuan, any fiat currency, they're going to be left holding the bag. And that's why I've been warning people about this for so many years. And I think we're very much near this end game. The other thing that Trump announced yesterday is that the EU should hit China and India with 100% tariffs to pressure Vladimir Putin. Well, they're not going to do that. They're going to double down, and they're going to focus on multipolarity. He's just given another impetus to BRICS unity. That's what I think is happening. And the quicker BRICS gets its act together, and I'm not saying BRICS are going to be perfect, and I don't think they will, but what it means is that the US is going to be hurt by this, because countries won't want to deal with the US anymore. So if you don't deal with the country anymore, you won't need its currency anymore. So a lot of those dollars that are offshore, held by these countries, they're going to come back to the US, and that's going to create a tsunami of supply. So that means less value. It's the law of supply and demand. Is Trump doing this by design? It's possible, because Trump, in his business career, is known to have driven many companies to the ground and filed for bankruptcy. Those companies, and reorganize them. Can you do this with a country? Well, maybe he thinks he can. So I would say that this is dollar demolition by design. That's the policy that we have here. And the other thing is, America's foreign policy is accelerating de-dollarization. And the last thing I'm going to say is, have you got gold? Because you're going to need it.
Silver's new critical mineral designation is more than a label, it's a strategic move. As VinceLanci explains, it allows the U.S. government to accumulate it quietly. If the U.S. mishandles tariffs, we will starve our own industry. VinceLanci warns that restricting raw imports would only drive silver and copper to China, raising costs and undermining American manufacturers. The rule is simple: you don't tax what you need. The precious metals' impressive performance, gaining over 37% year-to-date, has significantly outpaced both gold, 33%, and the S&P 500, 9%, capturing investor attention worldwide. This outperformance comes against a backdrop of 5 consecutive years of structural supply deficits, creating a foundation for price appreciation even before the current silver tariffs impact considerations. Ignore the noise from CPI and PPI. Vince says any dip in gold or stocks is a buying opportunity, as Powell's stance won't change unless the numbers are extreme. Let's get back to the interview.
A quick word about the uncertainty surrounding the silver tariff situation. We have to bring out the wheel of mercantilism for this. I'm reading a little bit of script. I recorded this morning. Silver has been added to the critical minerals list. As a critical mineral, that means the United States can now hoard it. The government can buy it without announcing it. They can just buy it. That means we want it to flow into the country. So while tariffs will continue to be speculated upon for silver coming in, it would be economic suicide and a sign of complete government incompetence if we did such a thing. We're trying to stem the loss of industry. That's why you prevent finished goods like cars and solar panels from being sold here when we can make our own, or should make our own. But you can't tariff silver that you need to buy. Maybe you can tariff finished goods with silver, but what qualifies as a finished good is the key point, and we're going to touch on that. Tariff solar panels coming into the US from China. That's fine, but don't tariff silver. You want the raw material. We're trying to reverse a tide. Silver is leaving the Americas and going to China. Copper is leaving the Americas and going to China. You want to give people a reason to sell it to you. Tariffs would be, economic suicide. The fact that it's even being discussed tells you that the people finally looking at this are still trying to figure it out, and that's frightening. The copper faux pas is what I'm talking about. We announced a couple weeks ago, we were going to tariff finished goods in copper. Copper is the parallel for silver in my concern about government policy and how it could actually hurt our industry. You don't want the U.S. importing any finished good that puts money in another country's pocket when we can make it here. The problem is it doesn't apply to raw materials. The bigger problem is, this is where the copper thing came in, semi-finished copper goods that we absolutely need for our own manufacturing, copper cathodes that go into batteries. The gray area between finished and unfinished, semi-finished, is where the issue lies. Do we need raw silver? Yes. Do we need silver embedded in a solar panel? No, we don't want it. Keep it out. Why do you keep it out? Because it's too expensive. You just want the raw silver. You don't want to buy a silver panel at retail price and break it down for the silver. What about in the middle? This is the problem here. And I'm going to give you an example that's going to be, this is the gold example. Semi-finished silver. This is actually happening in gold right now. Silver, raw silver, even if it's monetary, or they don't call it monetary silver anymore, but monetary form, has a stamp on it from the refiner, right? It can be considered finished, right? But is it really? All you have to do is remelt it, which is what they're doing in gold right now, and it becomes unwrought. Remove the brand, and that's it. That's the problem. The problem is the gray area. The institutions that know we need the silver must drive this point home to the government. I'm talking about the banks and the institutional representatives, who are doing that, I believe. They need to make sure the government understands this, and they will. Now, if it sounds like I'm pro-bank, no, I'm just pro us getting the silver we need. The silver price is going to go up anyway, okay? And yes, I would love for the bullion banks to get hosed because they don't have the silver because of the tariffs. But all it would do is if we raise the tariffs, it would just drive the silver somewhere else, and we won't get it, and the price will still go up. Okay, maybe that's not a bad idea. But to reiterate, it would be suicide if we tariffed all incoming silver. We would not be making manufacturing great again if we did that. All it would do is drive up the price and push all the silver in the world into China's hands. It would accelerate silver concentrate and doré bars leaving the US, South America, and Mexico. It would be a disaster for domestic industry. Prices would rise, and we would buy none. None. On the flip side, we want all the silver we can get. Our countries, other countries, I should say, especially those not friendly with us, they're going to respond by restricting exports, right? They'll say, we're not going to export unfinished silver to you. They'll do with silver what China's done with lithium. They'll demand higher prices. They'll have their workers go on strike. They'll want manufacturing facilities built in their countries or other conditions. So again, if the US government tariffs silver without making a clear distinction between wrought and unwrought and semi-finished, or what all these divisions are, the industry will be messed up. You know, you don't tax what you need, you tax what you don't need. We don't need French wine, right? Tax it. We don't need Costco umbrellas from China. Tax them. Tax the hell out of them. But we do need raw silver. Now, I don't care if it comes in the form of a sword. Get it here. There's not really a lot of value added to a sword there, hopefully. CPI. PPI is today. I think it's due out at 0.3. Again, unless it's at infinity, it should not affect Powell's decision based on his most recent statements. So if you've got money and you're looking to put it in and PPI comes out hot and stocks drop or gold drops, consider that might be a dip to buy. Maybe you want to wait for CPI, but just keep that in mind. And there's the grid. There's the grid. Let's go to the chart. I want to touch on this. There's the weekly, right? Okay. So I have my notes here for this. Okay. You make your own decisions, guys. Okay, but I want to give you the next steps of where we are now that we're in the middle of a winter here. All right, so this is the week that starts it off. So this is week 1. The next week is week 2 that we're in now. Okay, so this is week 0 in my world. All right, this is week 1. Now, I personally bought when the market got above here. So we're going to call it 35.20. That's where I bought. So it comes in right around here. Right, which is, a good entry because it's a breakout of the triangle, it's a breakout of the range, and that's just a tactical place to do it. But this is the wind beneath your wings. Okay, so let's go by the rules. 25.20 was my buy-in. What was my risk? My initial risk, based on the rules, is all the way down to 40 to 50, 54.20. So that's $100.
Institutional investors have shifted strategy, actively securing physical silver allocations rather than relying solely on paper contracts. This fundamental change in approach stems from growing concerns about future metal availability should trade restrictions materialize. With gold already up $128 from his entry point, the real question is whether to take profits or let the trade run to its next target. So, when the next headline hits, will you be positioned with something tangible that has a 5,000-year history as a true store of value? Drop your thoughts in the comments section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.